Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be going over stocks with ex-dividends next week. So every week on Wednesday, we release a segment covering stocks with ex-dividends coming Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be going over stocks with ex-dividends next week. So every Wednesday at 8 o'clock, we release a video covering stocks with ex-dividends next week. We screen these stocks for price-earnings ratio less than the S&P 500, which is currently around 24.78. We round it up to 25, so we're looking for stocks under 25 PE ratio. Next, we look for yields over the S&P 500. Right now, it's like at 1.7%. We're going to go ahead and say 1.5. So we'll just round down for that instance. So yields over 1.5. So if we get an Apple in there, Starbucks in there, they're not going to get disqualified. They're still great stocks. So we're going to round down 1.5 for yield. Now we're also going to be looking for increasing revenue year over year. Over the last 10 years, we want to have positive revenue. We want to have positive net income. We want to have positive free cash flow. Free cash flow may not be as important because that's that money that's being left over, being paid to their shareholders. That's the, the excess earnings. Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering stocks with ex-dividends next week. So every Wednesday we release a video covering stocks with ex-dividends next week. These are screened for price-earnings ratio less than the S&P 500 average, which is 24.7, but we round up to 25. We also look for dividend yields over the S&P 500 average, which is around 1.7, 1.6, depending on the day. We're going to go ahead and round that down. We're not going to disclude some of these stocks such as Apple and Starbucks that may have a yield below 2%. So we're going to go ahead and round down for yield to 1.5 and up. Next, we're going to look for stocks with increasing revenue, net income, and free cash flow over the last 10 years. And if you followed the same statistics that I used with financial metrics, you would have seen long ago that General Electric was going down in net income, down in revenue, down in free cash flow. You could have dropped out of that falling knife long ago and invested in some stocks that instead are rising up year after year for the long term. And also, our last one is looking at price-earnings ratio. Currently and in the future, is that price-earnings ratio expected to go down, which means their earnings are going up in comparison to their price. So we want a PE ratio moving down versus going up. If the PE goes up, that means that their current price that they're locked in at, their earnings have actually dropped, causing their price-earnings ratio to increase their price in comparison to their earnings, the offset there. So that's what we're going to be screening these stocks for. So we're going to cover around 50 to 75 stocks during this process. So the very first thing we do is head over to Dividend.com. Next, we're going to click on some ex-dividend dates. We're going to go ahead and deselect everything here but common shares. You guys can leave preferred shares, but I just go ahead and deselect it. We're looking for stocks between June 10th and June 16th. And let's go ahead and hit search. Now, if you have a logon for Dividend.com, it's completely free. You'll be able to see these DARS rating scores. Now, if you sort this too often, you're going to get locked out for the time being. You may need to jump over to a new browser, clear your cache out. Let's see here. So all I did here was sort it by the DARS rating system. What is the DARS rating system? They have it right here. You guys can go ahead and pause the video. Anything with a 4.6 to 5 is highly recommended. 3.6 to 4.5 is recommended. So what I like to do during the screening process is pick all the stocks that are rated at a 3.6 or higher, or until we kind of cap out our Y charts, and then put those over into our Y charts and do the screening process on there. So if we jump back over here and take a look at these stocks, we see a lot of 5s here. Lots of stocks. We got Pinnacle Foods, Best Buy, Community Trust Bancorp, Motorola is rated at a 5, SY Bancorp, a couple other stocks I'm not really familiar with. We have Ross Stores, we have Chesapeake Utilities, and a few others. You're going to notice Texas Roadhouse. Now, there's lots of stocks in here. I have no idea what they do, what their mode is, but this whole process I like to go through every single week exposes me to brand new stocks that I would never have heard on the media, on other outlets, on other YouTubers' channels. This gets me good exposure to stocks that are outside of my norm. So here, what we're going to be doing is I'm going to go ahead and pull my Y charts over here now. And all I'm going to be doing is entering these ticker symbols from Dividend.com over into Y charts. Now I'm going to spend the next few minutes doing this whole little process here, and then once I have done that, I'm going to go ahead and pause the video right now, and I will be right back. Okay, and we're back. So right now I screened all the way from ticker symbol PF all the way down here to ticker symbol EPM, which is Evolution Petroleum Corp. Now, we didn't quite hit into the 3.6s. You can see here that we had quite a few more to cover, and then including those 3.6s. When I copied that data over and put it into my Excel document, this is actually a list of 81 stocks. So we're getting exposure right now to 81 different stocks. Now, this method right here is a very quick screening process that I use. It's not perfect, but this definitely, instead of spending time going through each stock individually, looking at their balance sheet, looking at their numbers, individually looking at, what's their moat. Instead, I can screen 81 of these stocks. So 2, 4, 6, 8, 10, 12. So I can only screen 12 stocks at once. So I'm going to go ahead and deselect the rest of these. Now, by doing this process, I may only have really, if I take a look at blue chip companies, I may only end up looking at Coca-Cola, at Ross Stores. I wouldn't consider Ross Stores a blue chip, but we have Merck right there as well. But a lot of these other ones, 90% of these other stocks, I would have never even considered looking at. Sprint is not a dividend paying stock. I don't believe that one was on my list. And Domino's Pizza, that's there. That's pretty interesting. Hewlett Packard right there, Coca-Cola right there at the bottom. So as the list here, the stocks towards the bottom, those had a little bit lower rating. Now we have 12 stocks currently selected. So the first thing I'm going to be doing is going over my financial metrics. Now the first thing I like to knock them out for is price earnings ratio over 25. So go ahead. You don't have to change it to 1 year. It doesn't really matter whether you're looking at it in a 1 year or a 10-year chart, but we're going to go ahead and knock out anything with a price earnings ratio over 25. So let's see, what was this? Helium, so 44.67. This is this Helium brand PE, so it's about the 5th stock up. So if we count from the bottom here, 5 up, Helium brand right there. Next, okay, now we're left with the remaining 11 stocks that have price earnings ratio less than 25. So let's go ahead and load up on the next 12. So 4, 6, 8, 10, 12. Now this process, it may seem like it takes quite a while to go through this, but you're looking that I'm going to be screening through 81 stocks right now. So this whole process, I may spend about 30 minutes screening 81 stocks for financial metrics, but at the end of the day, I'm going to have a good list of stocks that have price earnings ratio less than 25, yields greater than 1.25, rising revenue, net income, free cash flow, and now I can go take a look at their moat, their balance sheet. Who are they competing against? Are they losing market share to them? Are they gaining market share to their competitors? What are their products, their services that they have out there that are giving them an edge in the future? Are they moving into new, are they making acquisitions? Are they acquiring smaller stores? So this whole process kind of gets me, from 80 stocks down to, usually I end up with around 3 to 6 stocks. Some amount of numbers I just kind of clicked in there. But I'm going to go ahead, and I may have clicked one too many. So there we are. So as we kind of move through this list, I can go ahead and pause this as well. But during this process, all I'm doing is going through and removing the stocks here that have a higher price earnings ratio, higher than the S&P 500. I don't care about the name because there's thousands of stocks out there. If I sit and nitpick, oh no, I don't want to remove that one because it's Starbucks or it's Apple or it's Coca-Cola. But a lot of these, Fidelity, for example, you may use them as a broker. You may have something in your mind that's saying, you know what, I'm going to give Fidelity a go. I'm not going to remove it from my list. And then, you invest in that company because, you got that brand loyalty, but the financial metrics may not have. So Merck, for example, it's a great brand. My wife owns it in her Roth IRA portfolio, but during this process, it wouldn't be one of those ones that's highly recommended. Thermo, let's go ahead and remove that one. Energies, and we still got quite a few here that we're knocking out. So as you can see here, this little process, it does take a little bit, but we do thin down our list quite a bit. Whoop, hey, there we go. That should be 12. Okay, go back up. Pink, about in the middle, Briggs. We've screened this one in the past. I know when I've done the screening process, I need to go back through and look at stocks that I've done this for and do a comparison. Where were they 3 months ago? Where were they, where were they 6 months ago? And where are they at now? A lot of stocks that we probably go back and look at that were on this list, that would be an interesting video, I think. I think I may end up doing that. I'll go back and do a 3 month and a 6 month comparison, because 3 months ago, we're in June right now, so 3 months ago was March. That would have been at the bottom of the market, near the bottom of the market. And if we go back 6 months, that would have been at the very top of the market back in January. So I think both of those would be great topics to go back, grab a couple stocks that we did this whole process for, see where they were at, see where they are now, and as far as their price, did they go up, did they go down, did they cut their dividend? Coca-Cola there looking like a high PE ratio. I don't look at the brand. I don't do favorites right now. This whole process, I just go ahead and look at the numbers. If the numbers don't meet my criteria, I remove them. Okay, now we have knocked out all the stocks with price earnings ratio less than or over 25. Next, I'm going to look at dividend yield. I want dividend yields that are higher than 1.5. So instead of keeping you guys on here for the entire time while I'm doing this process, I'm just going to keep you on here for a second. So here in the black, we have Stephen Madden. Going to go ahead and remove that stock. And the remaining ones there have all yields over 5. So I'm going to go ahead and deselect these and move on to the next bundle of 12, the next dozen, 4, 6, 8, 10, 12. And as I go through here, just look on the side here, match the color to Enterprise. Go ahead and remove Enterprise. So pause in the video now. I will be right back. Okay, and we are back. So we have screened these stocks so far. Price earnings ratio, anything higher than 25, remove from our list. Next, anything with a dividend yield under 1.5, remove from our list. Now we are sitting here with roughly 30-40 stocks still. Next, what I like to look for is I bring in my revenue, my net income, switch with my 10-year chart, go down here to my data format, switch with the percent change. Now what I like to see in a stock is positive numbers. I like to see positive revenue, positive net income, positive free cash flow. If it meets all three, I go ahead and move on to the next one. Positive numbers, great numbers, moving on to the next one. Best Buy, retail, they've been hit, recently pretty hard. Their earnings, I believe, in the last quarter, I think they just did their quarterly report. I'm not 100% sure if I think their online sales had decreased. That's what people were looking at, and I believe that's what caused their stock to tumble. Let me take a quick BBY stock. Let's go ahead and take a look at this over the last month. Yeah, okay, so yeah, they may have released some earnings, caused their stock to plummet. I may have talked about that in a video, but there's so many stocks rattled around in my head that I can't think of them all. Anyways, it does not meet the net income criteria. Gonna go ahead and knock it off my list. Positive numbers. So here, positive or negative free cash flow as a financial institution, that could be pretty common, but I'm going to go ahead and see. We have so many stocks here to cover. I'm going to go ahead and knock off anything that with a negative number, negative free cash flow. We have stocks with positive free cash flow, positive net income. Here, for example, Motorola. This one's not going anywhere. Decreasing revenue by 60% over the last 10 years, decreasing free cash flow by 74%, decreasing net income by 124%. If you average that over 10 years, they're losing 6% on average of their revenue. They're losing 7.42% of their free cash flow on average per year, and they're going down roughly 12% in net income every single year for the past 10 years. Guess who came out 10 years ago? Apple. iPhones. So Motorola used to be on top, now they're going down into the ground. Next, we have Huntington, positive numbers. Going to go ahead and continue. Positive numbers. Horrence, we got negative free cash flow. While it's not bad to see negative free cash flow, I'm going to go ahead and remove it. We have the NASDAQ. I'm not sure why I have an index in there, NDAQ, but I'm going to go ahead, NASDAQ. I wonder if that's a stock. I'm going to go ahead and just remove it. I don't know if it's a individual stock. I haven't seen that before. We have positive numbers here. Bancorp, South Bank, positive numbers. See, it's another financial institution with positive free cash flow. Here we got positive numbers. Positive numbers. So I'm going to go ahead. Maybe I'll just kind of keep you guys on the line because this process itself, I'm going to go ahead and just go quickly through here. Anything with a negative, go ahead and remove it from my list and move on to the next one. I don't need to spend a whole lot of time reading what company it is because right now I'm doing my screening process. I don't care what the company is. At the very end, I will care what stocks I have remaining. Then I'll go look at their balance sheet, go take a look at their moat. Do they have any product services that they're offering that other companies within that same sector are not offering? Are they, are they being intuitive? Are they coming up with new products? Are their products moving up? Do they have any competition coming in? How easy is it to get into that specific moat and build a company that's competitive? If you have a retail business, there's a lot of retail businesses out there. You have to have a specific niche. If you go out there and make another hot topic, but you sell gothic stuff and some other stuff, that's kind of a a niche there, right? So we have some negative numbers here towards the bottom quite a bit. A lot of negative net revenue there, and we got some positives. Here we go. So now we're roughly, looks like maybe 15, 20 stocks now. Price earnings ratio less than 25. Yields over 1.5. Rising revenue, rising net income, rising free cash flow. Now, next thing I like to look at is PE ratio and future price earnings ratio. So let's go ahead and we can keep it at the 10-year. That's not going to make a difference. But here we have PE ratio and forward PE. So currently our PE ratio, let's go ahead, change it back to data format. If you guys use Y charts, go back to the original data format. So right here, the PE ratio that is currently at is in the blue. The future price earnings ratio is here in the orange. Now if we go and take a look here, let's go ahead and go over the Yahoo Finance and see how accurate this information is. So ticker symbol PF. Ticker symbol PF. I know a couple of people have mentioned that. So we have PE ratio 14.42. Let's go ahead and check it out. 13.55, 14.42. It does depend on the day whether the price goes up or down. Let's go over to our statistics. That's where we should see our future. Forward PE here at 20.18. Forward PE ratio being higher means that their earnings are expected to decline in the future in the next 12 months, whereas their price may remain about the same, but their earnings are expected to decline, causing their price in comparison to their earnings to grow, and that's why you get that forward PE of a much higher. So here, for example, I'm going to go ahead and knock that one off my list. So now I know I'm looking, and it's pretty reliable, that I'm looking for current blue over orange. So here, blue over orange, that works out good. UGI, orange over blue. We want blue over orange, so here, orange over blue. Blue over orange, that's good. Blue over orange, that one's quite a big drop here, currently at 22.66. Forward expected to go down to 16.94. They're expected in the future to be more profitable than they are currently. Now I don't normally do this process here, but because we had such a long list, I needed to use some more metrics in order to knock this out. So blue over orange, again, that's what we want. Blue over orange, blue over orange, orange over blue, blue over orange. First Financial, blue over orange. You can see a lot of financial institutions that are doing well. They'll have that expected earnings to be better. So blue over orange, blue over orange. I'm going to go ahead and stop saying that now. Orange over blue. Okay, so now we're left with what? 2, 4, 6, 8, 10, 12, 13 stocks right now. Now, how else could we screen these stocks for to get down to a list of roughly 3 to 5 stocks? Now, something else we could do is look for within the year, is the current price trading below the yield? Now, here for example, this stock recently shot up. As of April, it's gone from $30 a share to $33 a share. It looks like it's kind of peaked out over the year. You can see that back in early December, it had peaked off at this dollar point at $33.30 before trailing back down, and it's probably fell below its 200-day moving average at $30. Broke it. Lots of investors jumped into it, rode it all the way back up to $33.30. I wouldn't recommend, looking at the data here, I wouldn't recommend this stock specifically because the price is greatly way over above the current yield. Whereas if you bought this stock back in August of 2017, that yield was way over the price. You could have rode that up from roughly $26 all the way up to currently $33.30. Plus, you'd be being paid out dividends. So here, let's go ahead. I'm just going to go ahead and continue. Okay, so I'm going to go ahead and knock off anything with a price over yield. So here we got Huntington orange over blue. So we want orange over blue. So right off the bat, I'm going to go ahead and go down my list. Hopefully, I'm not knocking off a bunch of stocks. You know what? I'm not going to do that. I'm not sure what stock I just knocked off, but let's go ahead and I'm not going to cover. Let's see here. Orange over blue, orange over blue. Okay, so how many do we have with orange over blue? There's 1, 2, 3, 4. So 4 stocks right there with orange over blue. So instead of knocking those ones out, instead what I'm going to be doing is I'm going to go ahead and use dividend.com for the remainder of my process here. Now what we're going to be looking for is payout ratios less than 60 and dividend growth for at least 5 years or longer. So starting off at the top, HBAN. And I'm going to go ahead and open it up a new tab, and we're going to go check it out here in just a second. I'm going to go ahead and get these all opened up, and then we're going to go and jump into each tab individually, sort them by how long they have had increasing dividends, and then take a look at some of their other statistics. So when I get this article posted out, it's going to have all of that information already on the stocks that made the cut at the very end. It's going to have their ex-dividend date, when is their payout date, their ratios for the last 10 years, their ratios over the last year. Are they at a pretty good buying price? Let's see. I'm talking and I can't type and talk at the same time because then I get a bunch of letters thrown in my head. So let's go ahead and finish this off. Whoa. B. What am I looking for? B, T, C, B, K. And then finally we have AIMC. Okay, let's go ahead and blow that one up. So here, starting off at the top, we have Huntington Bancorp's 5 years dividend growth. Great. Prosperity Bank Shares, 14 years dividend growth. Great. Bancorp South, 5 years. Great. 6 years, 6 years, 31 years. He's going to go ahead and move up to the front. 14 years is right up in second place. 6 years is over in third place area. We got a couple other 6-yearsers. We got an 8-year. We have a 4-year. I'm going to go ahead and cut that one. That's ticker symbol RNST. We have 7 years. That kind of moves up right next to the 8-year. We have 5 years, 4 years. Cut that one as well. And we have another 5-year. So, okay, now taking a look at these stocks, I'm going to go ahead. I'm not going to snap it to the right. Yeah, I'm going to go ahead. Whoops. Yeah, don't have much on my desktop. Let's see here. So in first place as far as dividend growth, we have ticker symbol THFF. This is a financial institution. Remember all those banks that stopped paying dividends, cut their dividends back in 2008, 2000 due to the tech boom and the cutback, and then also in the financial crisis that we had in 08 with the banks. This company did not cut their dividend. You know what they did? They continued to increase it since 1987. They only have they have a payout ratio of 30.7, which is amazing. That means if they lost half of their earnings, their payout ratio would only jump up to 60%. They would have that money on hand, that free cash flow, to be able to pay their shareholders. And they're currently paying out $1.02 a share. They're only priced at $44.75. If you're thinking about an investment, instead of a JP Morgan, a Goldman Sachs that's losing money over fists right now, if you take a look here, THFF, let's go bring this stock in here. Take a look at it. Now, it bottomed out here, it looks like in April of 2018. Hit that $42 mark. It hit that $42 mark back here in the past as well, back in August of 2017. And you can see here that once it bottomed out, it rode around here in the middle. Now it's kind of trending sideways. It's kind of building up momentum. This has a peak potential of, busting above $48, $50 mark. So this one, definitely a lot of upside to it in comparison to its downside. Also, dividend growth for the last 31 years. Great payout ratio. Second place, we have ticker symbol PB, Prosperity Bank Shares, another regional financial institution. 14 years of dividend growth. Again, continued to pay out during that recession since 2004. What did they do prior to that? It looks like 2004 is when they probably either halted it or something. Looks like they probably, they did a stock split. So they split their stock 2-for-1. So for every one share that you held, you now had 2. So if you had 100 shares, you now have 100 shares. If you have 1,000 shares, you now have 2,000 shares. And what they probably did here is hey, do we have enough money to continue paying out what we're currently paying out? They froze that dividend just for a little bit to kind of get their, their money straight. They're like, yeah, we got that money on hand. We can continue raising our dividend. They continue to pay out that 6-7 cents per share. And now you're getting double that income from those dividends. So great looking stock there as well. Next, we have Omnicorp Group, ticker symbol OMC, 8 years of dividend growth, payout ratio over 42.6. Again, if you double it, if they lost half their earnings for some reason or another, their payout ratio would still not go over or exceed 100%. They'd still have some earnings to be able to go back into their company and continue to grow and just kind of go through that depression point. Ex-dividend on June 13th. Payout on July 12th. I'm going to have that in my articles for these stocks here. Now, what happened in 2010? Let's take a look at their chart. Do they have it here? Doesn't look like they have their chart here available as far as what Dividend.com provides. So I can't tell you what exactly happened. They did do a stock split similar to PB or some other instance. But right now, great looking stock right now in third place. Then we have Packing Corp of America, 7 years of dividend growth. Again, low payout ratio, dividend yield at 2.61. June 14th, ex-dividend date. Move here towards the bottom. We can see that there was a cutback after that pullback in 2008. They were paying out 30 cents a share. They dropped down to, they cut their dividend by 50%. They pulled the GE on us. They cut their dividend by 50%, but continue to pay out dividends. They cut it down to 15 cents per share, then locked it in from 2009 to 2010. So about a year, a little bit over a year possibly, looks like. And then went up by 5 cents, then continued since that point to raise their dividend up and up and up. This could be a little one to kind of, don't rely on the dividends as much because they do have that cut due to their financial, back in 2008. Could still be a good stock just to kind of get into the industry. This is packaging and containers. Next we have Fidelity National Financials. Hey, you made the cut. Look at you. 6 years of dividend growth, payout ratio at 43%. Dividend yield, very nice dividend yield, 3.25. We move, they've been paying out dividends since 2012. Go down, look at 2012. What did they do in 2012? Looks like they, let's see here. Let's go look at 2008. They were paying out 30 cents a share. Then they cut, they cut their dividend by 50% as well. Again, a lot of these companies out there, they did it if you invest in those dividend aristocrat, champions, and what's the other one? Kings. those are normally stocks that have been paying out dividends for 10, 15, 25 years or more, depending on which ones you look for. Then we have Simmons First National Group, 6 years of dividend growth, 25.4% payout ratio, a little bit lower dividend yield at 1.84. Been paying out have been increasing their dividends since back in 2012, so didn't quite increase it through the recession period. Here, 2.88 yield, payout ratio under 60%, where I like to look at. 50% is what I like to look for or below. I still think 60% is healthy because oftentimes as the company increases their earnings, that payout ratio decreases for the year. Dividend growth is at 5 years. Next, we have Bank Corp South, ticker symbol BXS, 5 years dividend growth, payout ratio 25.1, a little bit lower dividend yield at 1.63. And in last place, we have Ultra Holdings Inc., ticker symbol AIMC, dividend yield at 1.59, 5 years of dividend growth, payout ratio at 27.8. Good looking stock there. Now, if we were to order these, let's go ahead and knock these out of here and put them in by how long they've been paying out that dividend growth. So we have THFF, PB, OMC, PKG. Those are 4, and then FNF. I think FNF was where we cut that down to SFNC, SFNC. You know what? I'm just going to go ahead and put these all in here. HBAN and BXS, AIMC. Okay, so of these ones, going from the top with those dividend increases for 31 years, is the stock currently trading at about even? Has the price kind of depressed below the average for the year? So right now, I would consider this right about average, just not at the bottom point, below $42 mark, but it's not at the peak of around $50 mark. There's more potential for it to grow up versus grow down, I believe. Plus, you're locking in a pretty good dividend yield of 2.25. It's not the highest where you would have got it at 2.4%, looks like, but it's still a good dividend yield, and you can always average in on the stock. Next, in second place, we have PB at 14 years of dividend growth. This one has came up, those little pullbacks that we had in January and February and March. Well, this one, it didn't have the pullback. It rose up very quickly in January. It did have that, looks like maybe a 10% pullback right there, but it quickly recovered all the way up, maybe had some terrible earnings, which caused them to just pull back down to their support line. Now they're kind of trending sideways, looking for that recovery period, but this could be a great one. You can see back, if you had purchased it in August 2017, you would have got into the stock at $55. That would have gave you that yield of way above 2.25%, the highest yield it's had in roughly ever. So you would have been at a great bond opportunity, not only in capital gains, but that yield on cost. You would have locked in a great yield on cost. That's why I like to look for stocks that are currently trading with a yield over price, because oftentimes that stocks are going to go up in the future just because they have great business themselves. Growing net income, growing revenue, growing net income, growing free cash flow. Those are great looking stocks here. This could be a great bond opportunity. OMC has been trending sideways in price. Their dividend yield is not at the peak point, but it's still at a great buying opportunity. The downside to the stock, you can see that it bottomed out at near $64, $65. Now, I'm not saying that any stock, there's always risk involved, whether you're buying any stock, that it will go down, it will go up. But if you're buying these stocks that have good financials, they have a good balance sheet, they have a good moat, those are things you have to look beyond the financial metrics. Don't just take the financial metrics and say, hey, I'm going to buy that right now due to the financial metrics. Also, go take a look at its quarterly reports. Did it beat their last quarterly reports? How is it doing on its yearly reports? Who are its competitors? Who are the risks? What kind of a moat does it have? What kind of services, products? Do your research on that stock. If it's a great buying opportunity, plus you've done the research, they look like a great opportunity, you buy and you average in if they do go down. But this stock, for example, I would say that it's kind of underloved. You can see here that as of peaking off in 2017. It has gone no one else but down since that peak point in 2017. So this is one I would go back over the yearly reports, take a look at what happened during that time, what kind of acquisitions, what did they change that caused the stock to just kind of go down. We have PKG here. Let's go ahead and flip over. Okay, Omni Group, 8 years of dividend growth. PKG, ticker symbol, well, we already covered the PKG. Packaging containers here. This stock has gone nowhere but up since early 2016 from roughly a little bit around that $40 mark all the way up to currently to $121. What percent is that? Let's go look at our percent here. That's up 76.71%. That looks, let's see if we double. No, that looks a little bit off there. But okay, my percentage calculator is not calculating that correctly. Anyways, we have let's see here, 1 year price at $121.10. Dividend yield's probably at its lowest point right now. This stock may have some upside, but it looks like it has also more downside right to it, unless you find out that the company's doing some breaking stuff and it's looking like it's going to continue to go up. Long term, if you buy and hold for the long term, it doesn't matter at the current stock price. You just buy, average in on those dips, and over the long term, as long as you chose those great stocks, you're going to be in a great position. Fidelity looks about average right now. Price and yield are currently in the middle. The price is not shooting up here at highs for the year, and the yield is currently not in the lows for the year. It's right at an average point. Now, recently, it has been kind of coming down. You can see that this is at support level right now, right around that $36 mark. It hits it, kind of bounces back up, kind of comes back down, doesn't quite hit $36 mark again, but goes back up. Now, maybe release some bad earnings, their forward expected stuff, their earnings are expected to kind of go down. They kind of changed it up. That would be something I'd read over the quarterly reports. And the stock went all the way back, hit that $36 point, bounced back up, hit that $36 point. So this could be one where you could be doing a quick buy, lock in that yield, good opportunity to go up versus go down. But of course, that history in the back here, it has came up quite a bit since 2017. Down from, let's see here, if we go back 3 years, the stock, for a time back in 2017, it kind of started at that $25 mark, so it's made quite a bit here, $36.95. Then we have Simmons, very high in comparison to its current yield. Huntington, yield over price right now. This one has had steady growth, not doing amazing, not doing terrible either. If you're buying and holding, this one you want to have terrible swings unless they release some horrible earnings reports that causes their stock to drop. Here, the dividend yield shooting up like that. If we bring in our dividend payout, you'll see that they increased their dividend here. They did their earnings call. They said, hey, you know what? Instead of paying that 8 cents per share, we're going to be doubling our dividend payout to 11 cents per share. And that's where that dividend just jumped up when that got paid out. That's what caused that dividend yield to kind of spike up there. And Bank Corp South shares, what's that called? Bank Corp South Bank, $34.40 right now. Yields at 1.58%. Not at the bottom, but it's definitely not in the middle. This company itself, just kind of looking at where it's been heading, this one potentially has more downside than upside, but again, you'd have to look at the financials, those last quarterly reports, what's the expected future quarterly reports over the next 4 quarters expected to be. All these stocks, remember, they currently have a price earnings ratio less than 25, and their future price earnings ratio is expected to go down, which in comparison to their price, meaning that their earnings are expected to grow. So take that with a grain of pepper. And then 1.59, 1.58 yield, but their price is down here at $42.90. So this quite a bit of upside potential. Let's go ahead and bring in ticker symbol AIMC. 5 years dividend growth, payout ratio at 27.8. Dividend yield right now of 1.58, 1.59 is right around there. It's industrial electric equipment. So what kind of electric equipment? That would be something interesting to kind of look at. So they do some mechanical power transmissions, motor control products. They do clutches, brakes for elevators, forklifts, lawnmowers. So during times of economy boosting, lots of jobs out there. Do you think the industrial sector, these industrial electric equipment, do you think people will be using these quite often and their sales will increase? Possibly. We could also bring in their price to book value, their price to sales ratio. Where's my PS ratio? I thought I had it. Yeah, there it is. We could take a look at these. So here, their price to sales ratio, they're at a 1.3. Their price to book value, their price in comparison to their book value of all their assets is at 3.0. So pretty good numbers right there themselves. So that's where I'm going to leave the video right now. There's so many financial metrics out there. If I try to cover, screen every single stock for all the financial metrics that I look for, if I go over their balance sheet, if I go over their moat, like what is every single stock, what's their sector, what do they do specifically, that would be a very long and drawn out video. I think we've been actually recording this video for now over an hour. So hopefully when I piece this video together, we're not going to be sitting there for over an hour. So anyways, that is it for this video. As a friendly disclaimer, I am not a financial advisor or tax professional. The information provided in these videos is for entertainment and fun. This is not investment advice. This is just me as a financial investor trying to help others make their money work for them, looking for some great dividend stocks to invest in, with X dividends coming up next week. These are all great looking stocks on the financial metrics as far as the ones that we screened for today. It's for you guys to decide, is the moat that they're in strong? Do they have any products or services that are coming out that would be beneficial to them, that would give them the edge? Are there any sort of competitions out there that are taking away market share from this company? Are they growing in market share? And continue. I have a whole strategy on my financial-investor.com. If you go to the About strategies, I have a whole little strategies there of how I screen stocks. Make sure they're profitable and such. So that's it for this video. Thank you guys for tuning in. Remember to like, comment, and subscribe if you have not yet subscribed. Thank you, everyone. Bye.